You've saved up some money and want to invest, but where? Should you buy hot stocks like Tesla or Apple or go with ETFs? It's a big decision, and the difference can be confusing. Today, we'll break down the real pros and cons of each and help you figure out which strategy could build your wealth faster. Welcome to Tech Monetize Official. I'm Sarah, and we're here to help you make smarter money moves. By the end, you'll know exactly where your hard-earned cash should go. Let's dive in. Before we dive into the details, let's make sure we're all on the same page about what we're actually comparing here. Investing can seem complicated, but at its core, it often comes down to a choice between two main options: individual stocks and exchange-traded funds, or ETFs. Understanding the basics of each is the first step to making smart decisions with your money. Let's start with individual stocks. When you buy a share of a company, you're literally buying a small piece of that business. If the company does well, think Apple launching a hit product or Tesla smashing sales records, your investment can grow quickly. But if the company stumbles, your money is on the line. There's no safety net. You're tied to the fate of that one business. In a way, picking a single stock is like placing a big bet at a casino. The potential rewards can be huge, but so can the risks. You might feel the rush of a big win or the sting of a sudden loss. It's a high-stakes game, and not everyone is comfortable with that level of uncertainty. Now, let's talk about ETFs, exchange-traded funds. Instead of putting all your eggs in one basket, ETFs let you spread your investment across dozens, hundreds, or even thousands of companies at once. When you buy a share of an ETF, you're buying a tiny piece of a whole collection of businesses, all bundled together. For example, the VOO ETF tracks the S&P 500 index, which means you're instantly invested in the 500 largest companies in the United States. That's everything from tech giants to banks to consumer brands, all in one simple purchase. The beauty of this approach is that if one company in the ETF has a bad year, it barely makes a dent in your overall investment. The other companies help balance things out, so your money isn't riding on just one outcome. That's the key difference. With stocks, you're making a concentrated bet on a single company. With ETFs, you're spreading your risk across many companies, industries, and sometimes even countries. Think of buying stocks like swinging for a home run in baseball. You might knock it out of the park, but you could also strike out. The highs are high, but the lows can be brutal. With ETFs, it's more like playing for consistent singles and doubles. You're aiming for steady, reliable growth over time, with less chance of a dramatic loss. It's a smoother ride, and for many investors, that peace of mind is worth a lot. Imagine owning one restaurant versus owning a tiny piece of every restaurant in town. If your single restaurant becomes the next big thing, you could make a fortune. But if it fails, you're out of luck. With a piece of every restaurant, you might not get rich overnight, but you're much less likely to lose everything. So, the real question is, do you want the excitement and potential big rewards of picking individual winners? Or do you prefer the safety and stability of owning a little bit of everything? There's no one-size-fits-all answer. It all comes down to your personal goals, your comfort with risk, and how much time and energy you want to spend researching investments. Some people love the thrill of stock picking, while others prefer the simplicity and peace of mind that ETFs offer. To sum it up, stocks mean betting on one company, with higher risk and potentially higher reward. ETFs mean owning a piece of many companies, with lower risk and steadier returns. Now that you know the basics, let's dig deeper into the real pros and cons of each approach, starting with ETFs and what makes them so popular among investors today. Why do so many investors love ETFs? It's simple. They offer a straightforward, efficient way to invest in the stock market without the need for constant monitoring or deep financial knowledge. Three main reasons stand out: diversification, low cost, and simplicity. These factors make ETFs an attractive option for both novice and experienced investors. First, let's talk about diversification. With just one click, you can own a piece of the entire market. This means your investment is spread across a wide range of companies and sectors. If one company fails, your portfolio barely notices. This broad exposure helps mitigate risk and provides a more stable investment experience. Second, cost. Most index ETFs charge tiny fees, sometimes just a few dollars a year on a $10,000 investment. These low costs mean you keep more of your returns. That means more of your money compounds over time, leading to potentially greater wealth accumulation in the long run. Third, simplicity. You don't need to research dozens of companies or constantly monitor the market. ETFs simplify the investment process. Just set up automatic investments and let the market work for you. This hands-off approach is perfect for those who prefer a more passive investment strategy. This hands-off approach helps you avoid emotional mistakes, like panic selling in a downturn. Staying the course can lead to better long-term results. But there are downsides. With ETFs, you'll never beat the market, you'll only match it. This means you won't experience the thrill of picking a stock that skyrockets, the market. No chance of picking the next Amazon and getting rich overnight. This can be a drawback for those looking for high-risk, high-reward opportunities. And beware of diversification, owning too many similar ETFs that all hold the same big stocks. This can dilute the benefits of diversification. In summary, ETFs offer broad diversification, low fees, and a stress-free way to build wealth over time. They are a solid choice for most investors. The trade-off? You're giving up the chance for explosive gains from a single stock pick, but for many, the stability and ease of ETFs are worth it. For most people, that's a great deal. ETFs provide a balanced, low-stress way to invest, making them an excellent choice for building long-term wealth. Now, let's talk about investing in individual stocks, the classic high-risk, high-reward path that has made fortunes, but also caused heartbreak. This approach is not for the faint of heart. It's a world where fortunes can be made overnight, but losses can come just as quickly. The upside? If you spot the next Amazon or Apple before the rest of the world catches on, your returns can be absolutely life-changing. A single smart pick can multiply your investment many times over, turning a small stake into a massive windfall. You have total control over what you own. You can build a portfolio that reflects your personal beliefs, interests, or deep research. Want to support green energy, tech innovation, or emerging markets? You decide exactly where your money goes. You can move quickly, react to breaking news, and double down on your convictions. If you believe in a company's future, you can act on it instantly. No waiting for a fund manager to catch up. But the risks are enormous, and the stakes are high. The same volatility that creates opportunity can also wipe out your gains in a flash. For every Amazon, there are thousands of companies that never make it. Think Blockbuster, Enron, or Pets.com. The graveyard of failed stocks is vast and sobering. Most individual stocks actually underperform the market as a whole. Picking the next big winner is like searching for a needle in a haystack, and the odds are stacked against you. Success demands relentless research, digging into financial statements, tracking industry trends, and staying on top of company news. It's not just about picking a name you like, it's about understanding the business inside and out. This is a serious commitment. It takes time, energy, and a willingness to keep learning. For most people, it's far more than a casual hobby. It can feel like a second job. And then there's the emotional roller coaster. It's easy to panic sell after a bad earnings report or get swept up in hype and buy at the wrong time. Emotions can sabotage even the smartest strategies. In short, individual stocks offer the potential for massive upside and total control, but they come with high risk, lots of work, and wild emotional swings. For most people, it's a tough and risky way to build wealth. If you choose this path, be prepared for the challenges and know exactly what you're getting into. So, which strategy actually builds wealth faster? For most people, ETFs win, hands down. The S&P 500 has averaged about 10% per year, and a simple ETF strategy can make you a millionaire over decades. Most stock pickers, even the pros, underperform the market. The odds are stacked against you. If you're not a dedicated expert, you'll likely get lower returns and more stress with individual stocks. But for a tiny group, those with skill, discipline, and time, stock picking can deliver extraordinary results. If you can consistently beat the market, your wealth can grow exponentially. The catch? Almost no one can do it. For 99% of people, ETFs are the faster, safer path to wealth. The best strategy is the one you can stick with for decades. Usually that's the simple automated ETF approach. So, how do you choose what's right for you? Start with your goals and time horizon. Long-term, ETFs are usually best. Short-term, consider safer options. Next, assess your risk tolerance. If a 30% drop would make you panic, stick with diversified ETFs. Think about your personality. Love research and analysis? Maybe try some stock picking. If not, keep it simple. Consider your time and knowledge. Stock picking takes serious effort. If you're busy, ETFs are your friend, but it doesn't have to be all or nothing. Try a core and explore approach. Put 80–90% in ETFs and use the rest to experiment with stocks. That way, you get steady growth and a little excitement without risking your future. Ultimately, self-awareness is key. There's no shame in choosing the simple path. The best plan is the one you'll actually follow, year after year. That's the real story of ETFs versus stocks. For most, ETFs offer simplicity, safety, and steady growth. For a few, stock picking can be a path to huge wealth, but it's risky and demanding. The most important thing? Make a conscious choice that fits your life and goals. Get started, stay consistent, and stick to your plan. Thanks for watching. If you found this helpful, subscribe for more investing tips. Let us know in the comments. Are you Team ETF, Team Stocks, or a mix of both?